The surprising resilience of the U.S. growth engine in 2023 has taken everyone by storm. As the year began, most anticipated a struggle due to the Fed's aggressive rate hikes. Yet, against all odds, the U.S. has managed to sidestep a recession, witness a surge in corporate earnings projections, and relish a robust comeback of major stock indices. Amid various explanations, a vital factor has gone largely unnoticed: U.S. private sector debt. Over the past 15 years, transformations in household and corporate indebtedness have reshaped the economy, profits, and equity valuations, making them less responsive to monetary policy than at any point in decades. But how have these shifts unfolded, and what lies behind this unexpected narrative? Welcome to Global Economic Drops, where we bring you simple summaries of important daily and weekly economic news from around the world. Our mission is to simplify the economy and help you navigate the treacherous waters facing investors today. So before we get into today's videos, hit that subscribe button and turn on post notifications by clicking the bell icon. And if you find our news briefs valuable, don't forget to hit the like button. Leave a comment down below telling us just what you think is going on with the state of the world, and share this video with a friend or two so that you can all stay updated together. Thanks for watching, and now let's dive into it. In an astonishing twist of events, the year 2023 has showcased the remarkable tenacity of U.S. growth, corporate earnings, and financial markets. A narrative hardly fathomed at the year's outset. This triumph defied expectations as the Federal Reserve embarked on an unyielding course of interest rate hikes. What's more, the U.S. not only evaded the looming specter of a recession, but also experienced a surge in corporate profits and a powerful resurgence in major stock market indices. Beyond the conventional narratives, a significant catalyst has been largely concealed: U.S. private sector debt. A critical juncture beckons for us to delve into the corporate debt narrative. While changes in household borrowing behaviors since the 2007-2009 global financial crisis have transformed total household debt relative to the GDP, the transformation of corporate borrowing has been equally impactful. A nuanced analysis reveals that corporations have not merely reduced their debt burden, but have also restructured their borrowing strategies. The pivotal shift lies in their reliance on long-term credit instruments over short-term borrowings like commercial paper or bank loans. This strategic transition has been a key element safeguarding corporate sectors against the harsh blows of aggressive Fed rate hikes. The transformation story doesn't stop there. In a surprising twist of fate, escalating interest rates haven't cast a discernible shadow on corporate profitability. This unique outcome warrants intensive scrutiny, as it carries profound implications for not only economic expansion and profits, but also credit market outcomes. Intriguingly, the seismic changes unleashed by the financial crisis have substantially altered the landscape of corporate borrowing. While corporations haven't slashed their overall debt as households have done, they have significantly altered the nature of their indebtedness. This shift finds its expression in an aversion to short-term borrowings and a preference for longer maturity and fixed-term public and private credit instruments. A striking illustration of this transformation is the shrinkage of the commercial paper market, contrasting starkly from the growth in the U.S. investment-grade and high-yield debt markets. With the commercial paper market diminishing from $2.2 trillion in mid-2007 to approximately $1.2 trillion in early August 2023, the investment-grade and high-yield debt markets burgeoned from $2.1 trillion to $7.8 trillion, and from $700 billion to $0.2 trillion, respectively. This shift toward fixed-rate borrowings, coupled with extended maturities ranging from 4 to 10 years, has crafted a scenario where the corporate sector remains remarkably insulated from the aggressive Fed rate hikes. Further intrigue is kindled by the contemporary data emanating from the second quarter of 2023's earnings season. An inverted yield curve with short-term rates exceeding long-term rates emerges as a central player. Companies equipped with substantial cash balances are capitalizing on this dynamic by channeling funds into short-dated notes for higher interest revenues. Concurrently, their long-term borrowings are anchored at low interest costs. The outcome is a corporate sector strategically leveraging the inverted yield curve for its advantage, translating into augmented earnings and elevated share prices. Remarkably, this strategic evolution has led to a reduction in net interest expenses as a percentage of net profit across virtually all sectors in the S&P 500 index, with exceptions in consumer staples and healthcare. In the grand picture of the S&P 500, net interest expenses now represent a mere 40% of their 2003 levels. This resurgence in earnings has propelled share prices upward and equipped the corporate sector with enhanced resilience to the Fed's tightening maneuvers. Yet, a pivotal question emerges: is this state of euphoria sustainable in the long haul? The answer, albeit complex, veers toward a cautious negative. While the corporate debt shield exhibits remarkable resilience, it is not impervious to the passage of time. The cycle necessitates new borrowings and the renewal of maturing debt. Should borrowing costs remain elevated, the glorious days could wane. Nonetheless, the corporate debt shield's longevity might persist, driven by significant maturity extensions that numerous companies have embraced. This extension is particularly pronounced in high-yield borrowers, revealing a potential lifeline should rates subside and enable companies to refinance on favorable terms. Notably, this transformative undercurrent has swept across diverse industries with varying degrees of impact. Financials lead the charge within the investment-grade sector, showcasing a 50% uptick in longer-dated debt. Conversely, energy and technology sectors have witnessed an over 25% increase. A dichotomy emerges with healthcare, which, due to an absence of a similar shift in debt maturity, has experienced net interest expenses chipping away at net earnings in recent quarters. In an intricate interplay, this resilience of profits, unscathed by the tightening grip of the Fed, reverberates as a force that sustains companies' appetite for hiring. A virtuous cycle materializes where profits bolster employment and, in turn, fuel demand. Although this symbiosis might not endure indefinitely, it has buttressed U.S. economic growth well into the heart of 2023. The implications for investors are multifaceted and consequential. First, a word of caution against forecasting recessions purely through historical benchmarks. The seismic shifts in U.S. private sector indebtedness following the global financial crisis have bestowed newfound stability and resilience upon the economy, defying conventional norms. Second, provided the ebbing of inflation and the persistence of moderate growth, interest rates may have peaked. A prospective fall could pave the way for companies to refinance under more favorable terms. The strategic use of time, especially for companies locked into longer maturities, emerges as a potent weapon in their arsenal. Lastly, investors are well advised to seize opportunities within credit market weaknesses, capitalizing on enhanced corporate debt fundamentals. While judicious discernment remains essential to navigate idiosyncratic credit risks, the prudent strategy of buying the dips appears warranted. In conclusion, the landscape of the U.S. economy in 2023 is a testament to its unanticipated resilience, guided in part by the strategic transformations in corporate borrowing. With the intricacies of this narrative in mind, readers are invited to contemplate the following. How do you envision the future of corporate debt dynamics shaping the course of economic growth and investor strategies? Share your thoughts in the comment section below. And remember to subscribe to the channel to stay up to date on global economic news. See you on the next video. And please like and share if you enjoy our content.